welcome. I'm your host, Henri Arslanian, and welcome to the special episode of the Future Money Podcast. Before we start, I want to say a big thank you to the 500,000 of you who follow my content each week. This podcast, The Future Money, is now ranked in the top 5% of all podcasts globally on Spotify. Thousands of you from over 160 countries globally are tuning in each week. So a massive thank you for all your support. Today's episode is a special one because it's really part of our Regulator series. I know over the last couple of months, many of you have reached out asking to have these conversations from regulators where we can hear from them about how they're thinking and most importantly, about how they see the digital assets ecosystem. And today we're very excited to have Ken Coghill, who's a director and head of innovation and technology risk supervision at the DFSA, the Dubai Financial Services Authority, to really shed some light on what is the DFSA doing? What is Dubai and the IFC doing when it comes to crypto? I know the UAE and Dubai in particular are very hot topic right now in the global crypto ecosystem. So we'll have hopefully the chance to discuss a lot of these topics and understand how is Dubai, DFSA different from other regulators, not only in the UAE and the country, but also how the DFSA sees crypto. Ken, great to have you on the show with us today.
Hi, Henri. Thanks for having me on.
Before we start, I always ask all of my guests, what is the one thing about them that people don't know? And I've had everything from hobbies to people like to do on the weekends. The one thing about you, Ken, that nobody knows was you're an extreme show fanatic. You were on a freestyle ski team. You were doing some pretty crazy stuff before your regulator career. I mean, it's so interesting. Like, can you share more about what we were doing in those crazy days, like on the freestyle, on the extreme show side?
Yeah, so I started off skiing as a young kid, and then went to a sports fair when I was just in high school, and watched a team that was putting on a show. They were a freestyle team, and in the off season they would put on demonstrations, and I said I want to do that. So I went and talked to them, and they said, "Come on out and train. We'll see how you do." So I started training, and for several years I was with them and putting on shows, and then competing in the wintertime in freestyle competitions. And then it got to be where the show was actually becoming more the focus than the winter event. And we started to add other things to it, like bikes. So we said one day, what about, can we jump this ramp on a BMX bike? So I started doing that on BMX bikes. We had trampoline involved in the show. And then we started putting things between the ramp and the landing to see if we could jump. We jumped an elephant one day, jumped a truck, and then said, well, how big of a truck can we get? So we knew somebody who had a semi-truck. So he rolled the semi-truck in between the ramp and the landing, and I went for it and jumped the semi-truck and did a backflip and landed. And that became the key feature of the show. And it just grew from there.
This is incredible. And people think that regulators are boring. Here we go. Like, this is probably the craziest. I've interviewed many regulators on the show over the years. I think this is the craziest story I've had from a background perspective.
We are sneaky. Sleepers.
Here we go. Well, Ken, actually, before we talk, there's so many questions, and I think a lot of topics we want to focus on. But maybe for the benefit of our audience, can you share with us what does the director and head of innovation, technology, risk supervision do at the DFSA, and also about your background as well when it comes to what you were doing before you became a regulator, and what do you focus on at the DFSA?
Sure. So my role focuses on the institutions that we regulate. So the innovation I'm focused on is how well financial institutions are managing the implementation of their innovation. So my team oversees our regulatory sandbox, for one, and any of the business models that might not go through the sandbox, but that are innovative in nature, basically technology enabled. So money and payments services. We have many institutions that are operating money service businesses across apps. So those would sit within my team. We have the expertise to monitor the technology risk. Crowdfunding alternative lending platforms. So businesses that are wholly offered through technology platforms. And most recently, crypto intermediary businesses fall within my team. So we have the expertise in the technology risk. We have the expertise in the cyber risk. We have a separate unit within the team that focuses on cyber risk. And we deploy that expertise across the universe of all 689 financial institutions that we regulate now. How I ended up here, well, after the thrill show days, long story, but that came to an end, and I had to get into a real career. But I had that, I had that energy, and the natural place for me to go was trading. So I started off as a floor trader in Chicago on the Chicago Board Options Exchange. I was an equity floor market maker, basically a trader in stock options. I was a specialist, posting all the quotes that you'd see when you look up online. I was one of 50 or 60 people in a very tight little crowd yelling and screaming for 6.5 hours a day. It fit perfectly with my adrenaline junkie attitude. So I did that for a little over 6 years as the industry moved from an open outcry environment to a technology environment. And at the CBOE, it was more of a hybrid. It was a side-by-side open outcry technology. It just became more difficult as a proprietary trader to survive in that environment. So I left the trading side and then went to work directly for the exchange in the market regulatory department, doing investigations on trading activity. Perfect fit in theory. I spent the first couple of months sitting in a cubicle just with a headache, wondering what I had done, leaving the environment of the trading floor, going to sitting in a very quiet room where you hear a pin drop and not a lot of talking going on. There was definitely no screaming. But I very quickly found my niche in there and where I could add value in understanding how markets could be manipulated, how options could be used to circumvent certain of the regulations, and began to enjoy it, and was then appointed to run a team to run investigations. So after about 2 years of doing that, I started to recognize there were some communication gaps between traders and the reg department, which tended to be lawyers. So I decided to go to law school at night. So I was working full time, going to law school at night, did that about 3 years. And in the US model, that gets you about halfway through law school. 3 years of part-time is halfway. And I received an opportunity to come to Dubai. So I decided to take a break. I was a little bit burned out at that point. I was also playing in a band at the time. So I was working as a regulator during the day, playing in a band on the weekends, and going to law school at night during the week. So I needed a break from everything. So I came to Dubai for 3 years with the intent to go back. And that was 12 years ago. And I'm still here in Dubai. So I came over with the expertise of the trading rooms, having some legal education and just a very aggressive attitude in just about every other respect. So I came and worked through several different areas of DFSA, which is one of the great things about working here. As much as you want to get involved in, you can. If you put your hand up for things, you can get that experience. So I moved across asset managers, brokers, and did some banking regulation for several years. I learned how to do that, and then was appointed to run an operational risk team. And then that very quickly grew into the innovation technology risk, which was the innovation sandbox, regulatory sandbox program with cyber risk supervision. It became money services and payments supervision, now crypto supervision. So it's just continued to expand. And that's
very
where
interesting.
up here.
Very, very interesting. I thought the freestyle thing was interesting. I didn't know you played in the band. What instrument did you play? What kind of
Drums.
music were you guys playing?
Drummer, everything. We had a 35-year gap. I was the youngest in the band between the band members. So we covered everything from Ray Charles to Dave Matthews to some Blondie to classic rock. Yeah, probably one of the most eclectic cover bands anybody's ever heard.
That's amazing. Here we go. Again, another example. People think regulators are boring. Here we go. That's a perfect example from that perspective. So Ken, let's jump. I want to jump right in and really, we have obviously listeners from over 160 countries. And often people, when they reach out to me, I get now every week people reach out and say, hey, I want to go to Dubai. I'm thinking of moving my crypto business to Dubai. Can you maybe explain for our audience, what is a DFSA? And what does it regulate, and how does it fit in the broader context of other regulators in the UAE?
Okay, let me start wide and then bring it in. So I know there's a common misconception: Dubai is a country. Dubai is not. Dubai is one of 7 cities that make up the United Arab Emirates. Okay, the United Arab Emirates as a country is regulated by there's the UAE Central Bank, and then there's the UAE Securities and Commodities Authority, ESCA. They have authority over the country. Within each emirate within the country, there are many free zones. And the free zones were established for a variety of different reasons to operate under different business rules. They allow different ownership requirements as opposed to in UAE proper. Now, in addition to all those included in all those free zones, there are 2 financial free zones. There's one in Abu Dhabi, and then there's the free zone that's in Dubai, which is the Dubai International Financial Center. And we, the Dubai Financial Services Authority, we are the regulator of all financial services that within the DIFC. So we have complete authority over that environment. That's about a 110-acre plot of land at the moment that sits within Dubai. So we are, in a sense, an onshore center. Now, the other regulator that is also very new is the Dubai Virtual Assets Regulatory Authority. So VARA has regulatory authority over any virtual asset activity that occurs within the Emirate of Dubai, with the exception of the DIFC. So we sit right now about a quarter of a mile away from the offices of VARA. All the institutions that operate in our center, they're under our authority. VARA does not have authority over ours. We are entirely independent of VARA. VARA has regulatory authority over anyone else that operates outside our center in Dubai. Down the road in ADGM is the Abu Dhabi Global Market, and the FSRA is the regulator down there. They have authority over any financial service activity that happens within the Abu Dhabi Global Market. Now, outside these two free zones, that's ASCA territory and Central Bank of the UAE territory.
See, it's very useful.
It's quite complex for such a small country.
Indeed, from that perspective, I often describe to people it's a country in a country, especially when it comes to DIFC and ADGM from a financial free zone perspective. Maybe can you share with us when a company, let's say financial institution, you mentioned there are 689 financial institutions that are regulated by the DFSA. What market can they service out of the DIFC being regulated by the DFSA?
Yeah, so a DFSA license permits a firm to provide its services in or from the DIFC, meaning they can provide their services to individuals or businesses that operate in the DIFC. You can also provide them onshore in Dubai. You can provide them in the wider UAE. You can provide them to the region, to any area outside the DIFC, or not restricted to the DIFC, barring any restrictions that a particular jurisdiction might put on an outside actor offering services. So with our license, we don't restrict anyone to doing business only in the DIFC. In a sense, it gives you global access, but that doesn't mean that if you were to provide services to, say, London, that Bank of England wouldn't have some requirements you'd have to meet to be able to do that.
I think it says exactly. I think a lot of people are using the DIFC as a global hub to service these markets. And maybe can you share let's focus on the crypto side, for example, and maybe you can touch upon on other financial institutions as well. What are the type of digital assets and traditional finance institutions that you think are a good fit for the DIFC and be regulated by the DFSA?
So where we've seen the most interest lately has been around the funds. So the DIFC was initially set up as an asset management center. It's now much more broad than that. We have 20. The GSIB now is 29 list. We have 27 of them. We have all but 2 of the GSIBs that are operating here. So banks are here. Everything except retail banking is permitted in retail lending. Everything else we have representation in brokerage, representation from asset management. There are funds that are set up here. We have 2 exchanges in the center. So all of them are candidates, I guess you could say, for that. Where we've seen the most interest has been in the fund space. Funds that want to invest in crypto funds that want to tokenize units of the funds. And then on the brokerage side, there's been the more common interest has been around derivatives on cryptos. Less so in the direct trading of crypto activity. It's been more of the indirect in the fund space is where we've seen it. Now that's just where the industry has expressed the interest to us, and then tokenizing traditional securities like units of a fund doesn't mean everything else. Our rules will support any other type of activity. Our rules will support exchanges operating in the center. Our rules do support the direct trading of cryptocurrencies as well.
Interesting. So actually, can we touch about that? So let's say I want to focus on a bit of the rules of the DFSA framework when it comes to digital assets. Before we talk about the rules today and as they stand, and I want to talk about the consultation paper that was issued by the DFSA and the future roadmap. Could you maybe share with us the approach to digital assets when it comes from a DFSA? What is the approach and kind of the history of how you guys approach digital assets to where we are right now?
Sure. So we started, it was in around 2018 that we started on the journey, and we identified 2 main categories. There was the crypto tokens, and then there was investment tokens. So we took crypto token, basically cryptocurrencies, and then those crypto assets that were representations of a traditional security. Those were the 2 verticals that we looked at. At the time, the interest that we were getting from the industry was in tokenizing traditional securities. And in a sense, that was the low-hanging fruit because there was a traditional security. We weren't creating a new product. We were simply creating a digital representation of an existing product. So in October 2021, that was when we published our first set of virtual asset rules, and that was for investment tokens. Now, interestingly enough, that's where the industry was telling us that it wanted to go and what it needed. It wasn't until about 6 months ago that we received the first application for an investment token. The industry very rapidly shifted its interest once we published the rules. It then became more focused in crypto tokens. So for the next year, we focused on developing a comprehensive regime of rules to support cryptocurrency business. And in November 2022, we published a comprehensive set of regulations. And I say comprehensive because most jurisdictions, say the FCA, for example, took an approach of creating an AML registration regime. And we didn't feel that was an appropriate direction for us to take. So we created a regime that looked at the technology governance, it considered custody, looked at disclosures and financial promotions, all the conduct of business elements that we would otherwise consider, looked at market abuse and fraud, in addition to considering AML. So we created rules that addressed our entire spectrum of supervisory risk that we would otherwise look at. And that was 2022. And then over the course of the period after we put those rules in place, we learned a lot about where the rules hit the mark and where they didn't necessarily hit the mark and where some adjustments need to be made. Now, the other point I'll highlight, an important element of our rule regime that went in place, is we allowed the cryptocurrency activity, and there's some various definitions of different types of tokens and a few prohibitions around algorithmic stablecoins and privacy tokens, so some of the details. But what's important is we have a recognition process involved. So we do have to recognize a token, a cryptocurrency, before it can be used. So we started off with 3. We said Bitcoin, Ethereum, and Litecoin. Those represented about 75-80% of the market, I believe, at the time. We did our own assessment on those, and we proved those right from the start. And then said from the time of the rules going forward, someone from the industry, either an applicant firm or an issuer, would have to apply to us, and there's a number of elements they'd have to provide to us in due diligence that we'd have to prove the tokens. Since then, we have received 2 applications, one for XRP, it's the Ripple token, and the other for Toncoin, and we've approved both of those. So we now have 5 coins, and we're at about 85%, I think, of the cryptocurrency traded volume with those 5 coins that are permitted to be used. Any other coin is eligible. It just someone has to apply to us, and we'll do a review on their due diligence, and if we approve it, and anyone is eligible to use that coin.
Can we focus on this point? Because I think there's 2 approaches that we have seen with regulators around the world. One of them is they regulate the activity. Let's say they regulate the asset manager, and that asset manager can trade, whatever it wants. I'm exaggerating a bit, but can trade pretty much a lot of the different types of assets, as long as they have internally a way to actually validate certain tokens. And the other approach, which is the one used by the DFSA, ADGM has the same thing in the region as well, where there's an approved list of tokens that these authorized firms, licensed firms, are able to use. Can you explain to us why was the approach chosen to have this approved list, and do you see this changing over the next couple of months or years?
In terms of time horizon, that's more difficult. I think it's fair to say this approach will evolve. So we took an approach of, we created a definition of the crypto token as a financial product. So we are focusing on the underlying product as opposed to just the activity. So we did do that. Our view on this was it's a stepped approach. So I think it's important to understand this is just our first step in the process. This isn't written in stone forever that this process is the way it will be. It's a matter of us getting comfort that the industry is able to do the due diligence on these tokens, and that the industry is making, I think, what you could say are probably appropriate decisions in the sort of tokens that they're offering to their clients. So there are a list of criteria that we need firms to go through and do the due diligence on. And as we see that they're able to get the information to answer these particular questions, and we can see that the information is available, and we get that comfort, then over time, I think it's entirely possible that we move more to a self-declaration type approach, as other jurisdictions have done. And we've seen other jurisdictions start off with a recognition process like we have, and then evolve to that. That's just a matter of volume. They have more institutions are engaging in business. There's been more activity in crypto, so they've been able to see a bit more of the output. And we look at that. That some of that has played a factor in what we're considering in this particular consultation that's gone out. So yeah, things will change. This is just our starting point, and right now we're in stage 2 with this consultation paper, and stage 3 and 4 will come, and it will open differently. Yeah.
So you mentioned the consultation paper. Recently, you guys released this consultation paper 153, which actually spent 2 weekends ago reading on a Saturday night. It was actually quite interesting, some of the propositions you guys are making there. Can you maybe share with our audience, maybe like obviously, and that sets out kind of the future direction of how the DFSA is looking at digital assets. Can you share with our audience what are some of the highlights of this consultation paper, and what are the key inputs that you are looking for from the crypto ecosystem?
Sure. So I guess the reason for the consultation is the industry feedback we get. So what drives our view on our direction on creating the rules is what is the industry telling us? First, what does the industry want to do? Where's the interest? And then we get feedback from the industry on how things work, and then we have to make some judgments on that. So the feedback told us we received a lot of feedback on the recognition process. So one of the key areas, there is a cost to the recognition process. So we are cutting that fee in half for the recognition. And we did receive a lot of feedback that was an entry to barrier to entry, and that wasn't the objective. So we recognize that we're cutting that in half. Stablecoin reserves. We have some rules around stablecoins, and currently, as the rules are written, we do require 80% cash for the reserves. We've received feedback from issuers of stablecoins that that's not practical, and it's not the way it's actually happening in practice. So in the consultation, it recognizes that, and we're moving away from requiring the cash reserve to saying you need to find the best way. As long as it's high quality liquid assets, you can divide that up however you need to, whether it's treasuries, cash. We're moving away from that prescription. We've changed the definition to on our fiat crypto tokens. So this is important because we have a prohibition on money services entities using tokens as yet. However, if they're going to use it for operational purposes in the background, they can use a fiat-backed stablecoin. Well, the fiat-backed stablecoin, we've narrowed that definition to it has to be a single currency-backed one-to-one coin. You can still use other stablecoins for other trading activities as a crypto token. They're just crypto tokens. We don't consider them fiat crypto tokens anymore. So that's important because for the money services, the concern there is as long as the token is being kept in the name of the business itself, not being transferred to the client, that mitigates a lot of the risk, a lot of the slippage in value. As long as the entity is bearing that and they're doing it one-to-one backed, that's a change we made. There's going to be some updates around the AML, provide some more clarification on how we expect firms to comply with the travel rule, and some more requirements around firms having a policy and procedure in place to comply with the travel rule. And that's maintaining our compliance with the country's requirements, and that goes in line with the FATF requirements. And as you can see recently, just last week, UAE came off the gray list. So that's an area where we're putting a lot of focus on the AML and the travel rules, an important element for crypto. Transaction monitoring. We had not said as much in the previous iteration of the rules around transaction monitoring. Now we're not necessarily requiring an institution to onboard one of the blockchain analysis tools. However, we are requiring them to have a policy and procedure in place to explain to us how they're doing that. We can't envision how somebody's going to do it without using one of those tools. If somebody comes up with a good way, we'll see that, but we've left a little bit of flexibility to do that. But in a sense, we are pushing firms to onboard those technologies to make sure they are doing that monitoring properly. There's some changes to the staking requirements, and in particular staking, we're focusing on the custodians only offering the staking, and then we put in a number of different requirements around the due diligence that we expect the custodians to do around the validators and the disclosures they need to give to their customers on that front. We've clarified around custody. We're not going to be prescriptive around whether there's a certain percentage held in hot or cold wallets. We're going to leave that up to each institution to decide how they feel best to mitigate that risk, but they have to disclose that to clients. They have to create a procedure and a procedure for how they're going to make that decision. Funds is an important area where we are providing more flexibility in the area of funds. So for external funds, meaning those foreign funds that are managed by a manager in the DFSA, they're allowed now to include up to 10% of their gross asset value in recognized tokens. And foreign funds can now be offered to clients in the DFSA or from the DFSA up to 10% of the value. And for domestic funds, we've allowed them up to 10% of non-recognized. So domestic funds are getting a little bit more flexibility. Foreign funds are getting a little more flexibility than we otherwise previously allowed. And that's directly in response to feedback that we've received from the industry. Now, there's requirements around that. I won't get into all those details, but as far as who the clients are and whether it's a qualified investor, but that's some of the more details. So those are some of the highlights of what's in the consultation.
Very interesting. And that 10% rule, it's something that I've seen in Hong Kong and other places as well. So that they've used that approach of the 10% limit. Okay, I want to focus on a couple of things from what you mentioned. One of them is the staking part with the staking as part of consultation can only be offered by custodians. Can you explain a bit the mindset there and what is the background of putting that requirement in place and what purpose does it serve from that perspective?
Okay. And this is one of the areas where, and this isn't fixed in stone. This is the view we've taken at this point in time, that where we've seen entities have the best systems and controls and ability to mitigate the risk around the staking is within the custodians. They've got the best resources at the moment. Now, that may change over time if individual institutions emerge that have that. So for now, our view on this was that to mitigate the risk, and there are a variety of different models that can be used for staking, and there are a number of risks involved in staking around whether bonding, unbonding periods, and the due diligence on the third parties that are offering the product, the validators. The view is taken that we need to start this a little bit slower rather than allowing everyone staking, and that's basically where that's at. It's a risk mitigation technique, but again, this is not set in stone forever. This is our starting point.
Interesting. Another big topic of debate when I have these conversations with regulators and regulatory circles is around crypto derivatives. I mean, you're by background, you're a derivative trader yourself, and you spent many years in the pit, like you mentioned earlier in the introduction. Can you explain, maybe for the benefit of our audience, what is the DFSA's approach to crypto derivatives, and how do you think the crypto derivatives regulatory licensing approach may change over the next couple of years?
Well, in derivatives, we permit the derivatives. I think where you're going to see probably change, and this is not unique to crypto derivatives, it's going to be around the level of leverage that's being offered to clients. In this region, the contract for difference, the CFD, is a very common, very popular product. And really, the only downside, it's just a swap product. The only downside to it is the amount of leverage that's offered into it. So it is something that we're monitoring with the crypto derivatives. At the moment, the same leverage that's been applied to the CFDs on traditional securities is being applied to the crypto. I think it's entirely possible, and maybe I shouldn't say that, or just say areas where this could go. We could over time loosen that, or we could decide that it needs to be more restrictive than it is in traditional securities. In the last few years, the argument's always been that, say, Bitcoin, Ethereum, they're not volatile. Ethereum, I think, is probably a little bit less volatile, but I think it's a hard argument to make in Bitcoin anymore that it's not a volatile security. I mean, I've heard very, very confident arguments over the last couple of years that we're making too much of it. It's just not a volatile product. So if that continues the way it is, it very well could be that we decide we need to be more restrictive. Now, that's gonna depend on how we see outcomes for clients. And that's where we're really focused on. What are the outcomes to the market? And if we see continual losses and increasing losses because of leverage, that's where we would address that issue. So the approach we're taking to derivatives is very similar to how we would take it with other products, but keeping an eye on the unique characteristics of crypto and what that might mean in the context of offering derivatives to particularly retail clients. And that's where the real concern is at.
Interesting. And you mentioned the particular characteristics of crypto. As a regulator, when you look at the future of digital assets, how do you think regulators will adapt to or will try to regulate the space at a big macro level because of the unique features of crypto? How do you see in your magic lamp the future of crypto regulation, and how you think it can evolve?
Well, crypto has, I think, created more interest and more collaboration between regulators. It has created a need to talk a lot more because financial services were borderless before. They're even more borderless now, if that's possible. And the difficulty with crypto, it's hard to know where it's being offered. It's hard to know where the transaction is actually taking place. Let's take wallets. The geolocation of a wallet is a very difficult, very challenging process to do, if it can actually even be done. The unanimity of wallets. So there are some areas that we're going to have to adapt to. And I think right now what we're doing is figuring out what we need to adapt to and what we don't need to adapt to. Take transaction monitoring. for example, regulators were all scrambling to get these different analysis tools and understand what's happening and how it's going on. The next question is going to be, how much of that monitoring should we be doing? Because it doesn't obviate the obligation on the institution to do it themselves. Are we doing the same thing they're doing? Are we creating some disincentive for them to do the monitoring if they believe we're doing the monitoring? So there are a number of things we have to think about. There is a lot of information that's available to us now in the world of crypto that is not available to us with conventional products. So how much of that do we need? How much of that should we be paying attention to? What should we really be doing with it? And I think over the next couple of years, there's going to be some different viewpoints on that, or some shifting views, and we're going to settle in on what we actually really need to be focusing on. And I'm not going to say whether any of it's right or wrong right now. It's just a matter of consuming all that information and processing it and understanding what it is and building that into our supervisor process. I think one thing that's important to a point to make, though, is our underlying supervision hasn't changed. We're still focused on the integrity of the market. We're still focused on protection of clients. It's just a matter of understanding, where does crypto create a different risk to clients, or does it increase the risk to clients? Are there any blind spots where there's a risk we're just not recognizing? And that's going to take a little more time to flesh all that out. But the underlying purpose of what we do is the same as it always has been. That just will never change. Protecting the market, we're protecting the users.
I mean, when it comes to protecting the market, protecting the users, as a regulator, obviously the DFSA went through this journey of adapting to crypto. First of all, how was the journey of that? How did you guys get up to speed on crypto? And what would be your recommendation to other regulators who are embarking on the same journey?
Yeah, that journey can be rather difficult. The first hard part about it is looking at crypto and recognizing either it's some fantasy new product that's entirely different from everything else, or looking at it, recognizing what are the conventional parallels. I think this was a bit of a challenge for us, finally coming to the realization that crypto is just enabling the same activities as before. You can call it DeFi, TradFi. The underlying activity is the same. You're just doing it a different way, a different distribution method. So we've spent a lot of time over the last 2 years. We've put 40% of our entire staff through training. We went through 2 levels of training, with everyone starting off with just the basics background on what is cryptocurrency, what is blockchain technology, what are the use cases, what are the trends in the market, moving into some more of the regulatory elements of it. What does this mean for governance? What does this mean for conduct of business? What does that mean for supervising for AML? We've moved from some of those to now we're doing some internal trainings. We do have experts internally, and we've created some of our bespoke training. And that bespoke training came out of the idea of, what are the conventional parallels to what's being done with blockchain technology? So blockchain technology operates in a lot of ways like a conventional market. Yes, it disintermediates the broker and the settlement and the clearance, but those functions are still being done. They're just being done in a different way. So now as we're understanding that, now we're honing in where we need to be understanding this a bit better and focusing our training across our staff. And I think that's very important to recognize the parallels. And IOSCO, their recent recommendations recognize this and acknowledge that you have to recognize, don't get caught up in the idea of blockchain and cryptocurrency. Look at what is it really doing, and how does that parallel with conventional models, and where are the gaps, where are the differences, and work from there.
Very interesting, and I think it's you guys have done a pretty good job in getting up to speed on the topic, and it's not easy. I think adapting the regulatory training, and like you said, looking at the different parallels, it's very, very interesting. And I have to say also IOSCO, I think IOSCO within the regulatory circles, in my opinion, doesn't get the credit it deserves. They've done a tremendous job over the years in bringing the regulators together and trying to create awareness and actually producing guidance for regulators around the world, especially those maybe who don't have the same resources or access to the knowledge as others, including Dubai, that have the access on that perspective. And actually, the one question I have on that point, you mentioned earlier that crypto brought regulators together. What is, for a lot of people that are not following the space on a regular basis like we do, often they'll say, regulators, they don't talk to each other, they don't, they don't correspond enough, they don't interact a lot. In crypto, can you share with us what is the level of interaction that a regulator like the DFSA has with other regulators, and what are kind of the types of interaction that is taking place when it comes to digital assets by regulators globally?
Sure. Regulators talk a lot. We just don't always necessarily tell everybody that we're talking. Right? We're all constantly comparing to each other. What are you seeing? What are you understanding about this? And I say crypto accelerated that because it was such a new thing, and it created, in a sense, some fear. So the Global Financial Innovation Network is one area we do that. We're close to 100 members now, different regulators that are members of GFIN. I want to say somewhere between 85 and 100 is the number right now, and we have regular engagement through that program. There's a variety of different programs. These are not all public, so the public wouldn't see this, but they're all designed around building knowledge, sharing information amongst the different regulators. Crypto is just one element. We focus on that. There's a variety of others, but crypto gets its attention. We have other engagements that we do. We have some periodic calls, quarterly calls with regulators around the world. We cover the Americas, we cover Asia, we cover Europe, we cover the regional regulators here, and we get on the phone and we have different topics. Each of us has areas of interest, things that we want to understand more about, and we have these calls and we share information on them. In between those calls, there are engagements bilaterally with different regulators where we know, they've issued some rules, they put out a consultation, we want feedback. We have those discussions. They call us up to get more feedback on what it is we really we're thinking when we put out some information in the consultation. We call them up. So it's the conversations are happening. The talking is happening. Now, there's obviously limits, and where I think the industry it gets concerned is there is an interest in, when I apply with one regulator, why can't you just share all that information with another? Well, there's data protection issues. That gets a bit trickier. But when we're talking just about how we regulate and how we supervise firms generally, there's a lot of discussion, and very open discussion, fortunately.
Yeah, I think you raise a very good point. I think people underestimate the level of interaction that regulators have between each other, which is very, very, very interesting. And Ken, when you look on the horizon, obviously you've been a regulator now for over a decade. How do you think the regulator of the future will look like? There's a lot of new technologies coming in, also a lot of new challenges, and obviously there's a lot of new technologies that obviously are playing a role on a daily basis in financial services. How do you think, can the regulator will look like in 20, 30 years, and how different would it be than what it is today?
We're definitely moving more, and most regulators are moving more to being data-driven regulators. They're going to see a lot more data with the new technologies. It's possible to do that. It's access to the information. I think so. We're going to be much more that way. I think going forward too, we're probably going to be able to look at a lot more things than we can now, for good or for bad for the industry. As we automate a lot of this process, it's going to free up the human resource to think a bit more about other risks and other areas that we couldn't focus. I mean, we're all risk-based. We'll continue to be that. I don't think that will change. We'll move from a risk-based to 100% compliance. That isn't necessarily good for growth, good for the industry. That's not the objective. But it's to make sure that we're able to, with limited resources, address the risks that need to be addressed, and that's always a challenge. We can never mitigate everything, but as we adopt more technologies and we become more data-driven, we'll be able to focus and have a better idea of whether or not we're focusing in the right place. So from people, I think we're always going to need people, just like compliance in the institutions. So to any of the compliance officers listening, you may need to reskill and readapt to how you're doing. But I don't see AI and the use of these automated monitoring tools displacing compliance any more than I see it displacing regulators. There's always going to be something new to be thinking about. There's always going to be something new that doesn't fit quite within the existing model, and that's where the people are going to be needing to think about it. So I think it's going to help speed us up. I think we will never be ahead of the industry. It's just not how it works. The industry innovates, figures out what it wants, and we have to respond to that. But our response, I think, will come quicker as we adopt technologies, and it helps us build our knowledge base.
That's amazing. And actually, what is the one piece of advice you'd have to any compliance officer today in financial services, based on what you know about not only crypto, but also about the future of regulations and the future of finance?
Piece of advice: keep learning. What compliance is today is not going to be compliance tomorrow. Compliance is more than just understanding the rules. So a good compliance officer needs to be as adept at what's happening, the trends in the industry, as the business side does.
Yeah. And I think it's difficult, actually, for a lot of compliance professionals. That is not an easy, naturally easy thing to do. It's been quite a challenge on that side. Last question, Ken, and before we move on to the fire round of questions, is what is you think? There's obviously a lot of the crypto community has been quite vocal about the regulators over the years. What is the biggest misconception you think the crypto ecosystem has on regulators, not only in Dubai, but also globally?
Only one. I think the biggest misconception is that we don't understand what these technologies are. And that's a huge misconception. And I can tell you, because we talk to other regulators, we were amazed constantly when we go to other jurisdictions, meet with them, to hear them talk about what they understand about the details. It's a challenge to take what we understand, craft those into requirements, and into requirements that everyone in the industry is going to accept. There's always going to be an element in the industry that says you're over-regulating me. Another one's going to say, well, you're under-regulating. There's different reasons for saying that. Parts of the industry wants more regulation because that becomes a barrier to other competition. Parts of it want less because they want more flexibility to do what they need. We're trying to balance all of these competing concerns, while at the same time making sure the end user clients are not the ones that are going to suffer, and market integrity is maintained, and financial stability. So we have to balance all those impacts. So it is a misconception because it takes us time to balance all of those elements into effective regulation. The misconception that we just don't understand what's going on. We're going to be a little bit behind the industry. I don't think it's unfair to say that, and unrealistic to say that, because the industry decides what it wants to implement and adopt, and we have to learn what the industry is doing. So we will certainly be a step or two behind, but we're not far behind. I can say hand on heart, we do, as a body of regulators, do get it.
Yeah, absolutely. And, in my personal and professional experience, I would say that the average regulator that I meet is way more knowledgeable than the average financial services professional. It's been actually quite, I think the community, the broader global crypto community, does not give enough credit, actually, I think, to regulators, like you said, because you guys are way more knowledgeable than many in the crypto community. I don't know if it's a bit of the belief, or people want to believe the regulators are behind, or it's a voluntary blindfulness, trying to not acknowledge it. But it is what it is on that side.
It's just difference in objectives in the industry. Nobody likes a regulation that inhibits them from doing something or prohibits them from doing something. And as soon as they see that, they say that regulation's there because they don't know what they're talking about.
Yeah, exactly. Well, Ken, my best friend, the Bell, is here. I'm going to ask you quick fire round of questions, and I need 1 or 2 word answers to my questions, and the Bell is here to keep us honest. Hope you're ready.
Okay.
Here we go. Let's see how your extreme sports skills come in handy. So, Ken, what is the one thing you love to do when you're not working as a regulator? What's your favorite thing to do when you're off work?
Cycling, water parks with the kids.
Here we go.
Drums.
Yeah. Great things to do in Dubai. What is the one thing about Dubai that people get wrong generally?
It's probably one of the most liberal cities in the world.
Yeah. Very interesting, huh? Yeah, very interesting point. If you're a trader, derivatives trader by background, if you could go back to trading, what kind of instruments would you love to trade?
Oh, I enjoyed trading the options, stock options. I would go back to doing that. Back in an open outcry environment, I loved it.
There you go. The good old days.
The competitive nature of it, I loved it.
There we go. If you could go back to university, Ken, tomorrow, what topic would you want to study?
Astronomy.
Astronomy, really?
Yeah, we're moving to Mars, all humans. So I'd like to know a bit more about what's out there.
I love it. What's your favorite regulator movie or any kind of enforcement movie that you've seen ever?
Not regulator, but I guess sort of legal. 12 Angry Men, old movie.
Of course. Classic about the role of juries, one of my favorites as well. You were an extreme sports athlete before. Who's in your opinion is the best extreme show athlete of all times?
Travis Pastrana.
What was his thing?
So Travis Pastrana, he's motocross pioneer. First backflip on motorcycles, double backflips, 360. Yeah, broke just probably every bone in his body.
I have to say, anybody in the extreme sports world, I find it fascinating. It takes a different personality. Ken, you used to play in a band. What's your favorite band of all time?
Oh, that's very difficult. That's going to be a list of probably about 20 bands. Wow. Well, right now I'm working on some Tool songs. So let me say Tool. They've got my attention right now. So
Here we go.
rock.
Here we go.
Aggressive
What
rock.
surprises you the most about the crypto industry? What is the one thing that surprises you the most about the crypto industry?
The misunderstanding of the point of regulation.
Ken, if you're not if you're not working as a regulator, what other industry, what other profession would you love to do?
Entertainment.
Entertainment. Here we go. What kind of entertainment?
Oh, if I could be a professional musician tomorrow, I'd do it if I had the skills.
Absolutely love it. And Ken, to really close off this episode of the Future Money podcast, this was Ken Coghill. He's the director and head of innovation and technology risk supervision at the DFSA. Ken, the traditional question on anybody who comes on the Future Money podcast: if you could have lunch or dinner with one person, dead or alive, lunch or dinner with one person, dead or alive, who would it be?
Nostradamus.
Ooh, and why is that? It's interesting.
I'd like to know what he was really thinking with some of his predictions.
Amazing. I love it. I love the astronomy, Nostradamus. I love how it's all coming together. Well, Ken, thanks for being on the show with us. I think it was very insightful. If people want to learn more about the DFSA, the DFSA's regulatory regime on crypto, how can they learn more?
So you can go to dfsa.ae, and on our main page there is a link for innovation in crypto, and from there that will link you to different areas of this of the site with some information about it.
Absolutely. Well, Ken, thank you for being with us.
If it's an institution, we have an inquiries link on the page, and they can send us an inquiry and set up a meeting to understand the registration process, the authorization process, and the supervision. That's also a possibility.
Amazing. Well, Ken, thanks for being with us. And guys, hopefully this was a useful episode. And I know many of you are looking at understanding better about the UAE and the regulatory regime. And hopefully this has been useful when it comes to understanding from a DFSA perspective within the DIFC. Thank you very much, everybody. And hope it was a useful episode. And see you all next time for another episode of the Future Money Podcast. See you guys soon.